Hello, welcome everyone. Thank you so much for joining us today. So I'm Hui Shi and I'm from the iFast research team. And so for today, I'm here to talk about a very popular investment style called income investing. So what is income investing is essentially centered on building an investment portfolio which aims to produce a passive stream of regular as well as sustainable income payouts. So when it comes to investments, there are actually two main sources of income, which are dividends as well as bond yields. Now that also brings me to the key building blocks of an income portfolio. So what exactly should go into an income portfolio? The first building block that we have identified is fixed income. They are also known as bonds, and we think that they can form the foundation of an income portfolio. So fixed income investments, as their name suggests, they tend to pay out a steady stream of income at a fixed interest rate to investors. And moreover, most bonds, they are designed to provide capital preservation, and as such, they tend to be less volatile. So this helps investors to balance out equity market volatility in a portfolio. Now, government and corporate bonds, they are your most common types of fixed income investments. And these bonds, they also tend to come with a credit rating. Entities with very strong balance sheets, they tend to issue debt which are known as investment-grade bonds. So examples of investment-grade bonds will be those issued by the Singapore government or by very strong companies. And on the other hand, there are also bonds which have a lower credit ratings. And for this kind of bonds, they tend to carry a higher level of risk. So they are called non-investment grade or high-yield bonds. So this kind of high-yield bonds, they can be issued by governments of emerging markets or by riskier companies. Now next, the second building block of an income portfolio that we have identified is high dividend equity markets. Investing in a very high dividend equity market can provide investors with a diversified exposure to high yielding stocks from different sectors. So to give you some color here, we have listed down all the markets under our research coverage, and they are being ranked by their dividend yields. So right at the top, you can actually see that we have Brazil. Now, Brazil is a very high dividend yielding market because around about 60% of its index constituents, they are from the financials, materials, and energy sectors, which pay out very attractive dividends. So next, the market with the second highest dividend yield is actually unsurprisingly Singapore. The Singapore equity market, as we know, it is pretty much focused on bank stocks, as well as real estate stocks, including the REITs. Now, going down the list, we also have Malaysia and ASEAN. Now, the sector composition of the Malaysian equity market is largely tilted towards financials, also known as the bank stocks. And meanwhile, ASEAN also has quite a high dividend yield, given that it is largely made up of high dividend markets, such as Singapore as well as Malaysia. And on the other hand, if we turn our attention towards the bottom of the table, you will find certain markets like the US as well as Korea. So for these markets, they tend to have relatively lower dividend yields. And the main reason for this is because the markets tend to focus more on tech stocks, which pay out little to no dividends. And therefore, if investors want to include this kind of markets into an income portfolio, we believe that it will be very wise for them to consider ETFs with a dividend tilt. So what do I mean by that? ETF with a dividend tilt, they tend to only invest in companies with very high dividend yields or companies with a track record of consistently increasing dividends. So that provides investors with a dedicated exposure to the high-yielding stocks of an equity market. And last but not least, the third as well as the final building block of an income portfolio that we have identified is none other than your dividend stocks. There are companies in specific sectors which have a track record of paying out very consistent or growing dividends to investors. So banks, for example, they have very stable businesses, so this allows them to pay out growing as well as sustainable dividends to their investors. Another example will be REITs. Here in Singapore, REITs, they are required to pay out at least 90% of their income earned as distributions to their unit holders. So with such a high payout ratio, that is also why REITs, they tend to have a much higher dividend yield as compared to other kinds of dividend stocks. However, do note that investments in a single stock, like investing in a single bank or a single REIT, it can be quite volatile, as their values, they may fluctuate in response to idiosyncratic risk, which is the risk involving an individual company. So therefore, we believe that investors who want to invest in dividend stocks, we believe that they should consider instruments such as an ETF, which can potentially value add from the perspective of diversification. So now that we have a better understanding of what kind of investments can go into an income portfolio, I think the next question that you'll probably have in mind is, how do I allocate between the different building blocks of fixed income, high dividend equity markets, as well as your dividend stocks? So for this, the rule of thumb is that the portion of your investments that is dedicated towards fixed income versus the riskier equities will largely depend on two things. One will be on your time horizon, and the second will be on your risk tolerance. Now, first, what is time horizon? This can be taken as the amount of time your investments will be held before the money is needed back. So an investor with a longer time horizon, they may feel more comfortable allocating a greater portion of their investment into equities because they can ride through the ups and downs of stock markets. So younger investors, for example, they can invest more aggressively since they have more time to make up for any losses. So in other words, they may want to consider a growth income portfolio. And on the other hand, investors who are getting closer to retirement or already retired, we think that they should invest more conservatively, as they will need to rely on their portfolio to cover for their living expenses in retirement. So therefore, this kind of investors, they may want to consider a conservative income portfolio, which is to put a greater portion of their investments into fixed income. Now, other than time horizon, I also think that investors should consider their risk tolerance. So this refers to the amount of market volatility or loss that you can or are willing to accept. So investors with a very low risk tolerance, they may prefer investments that are able to preserve their capital. So for them, they fit the profile of a conservative investor, putting more into fixed income. And on the other hand, investors with a high risk tolerance, they wouldn't mind sudden losses in order to get higher potential returns over the long run. So for them, they fit the profile of an aggressive investor, allocating more into equities. Now, another component of a very well-constructed income portfolio is actually called the practice of review and rebalance. And we think that this should be done either on a quarterly or a monthly basis. Investors can check to see if there's a need to adjust the portfolio's asset allocation to reflect market views. So taking today's market condition as an example, global bond yields have climbed to levels not seen in more than 1 decade. And with fixed income finally back in favor, providing the potential to deliver attractive yields at low risk, investors may want to consider overweighting their exposure to bonds in their income portfolios. And next, we've also come to rebalancing. Now, rebalancing, this is to bring your portfolio back to its original asset allocation mix. And this is necessary because over time, some of your investments may become out of alignment with your target asset allocation. And this will usually happen because some investments, they tend to grow faster compared to others. And so by rebalancing, you ensure that your portfolio returns to a level that aligns well with your investment horizon as well as your risk tolerance. So for example, let's say you are a moderately conservative investor, which means that stocks and bonds should make up about 30% and 70% of your portfolio respectively. But after a recent stock market increase, stocks, they now actually represent about 50% of your total portfolio value. So when this happens, you either need to sell some of your stocks or buy more bonds in order to bring your portfolio's asset allocation back to the original mix of 30 to 70. So in this way, it also ensures that you'll always be selling high as well as buying low. Now, for the most exciting part, we have here constructed a hypothetical model portfolio based on a moderately conservative risk profile. So that means it's 30% in equities, 70% in fixed income. Because if you are an investor looking for reliable income, then we think that your investment strategy is unlikely to be on the aggressive side. And in this model portfolio, we aim to achieve a 6% yield. Currently, core inflation in Singapore is at about 5%. So a 6% yield on investments sounds quite reasonable as it helps to potentially beat inflation. In the equity portion, we have chosen a total of 4 ETFs, and each of them are given an equal weight of 7.5% in the portfolio. And where possible, we also try to incorporate less US-listed ETFs in order to avoid dividend withholding tax. So if you can recall what I shared previously, Singapore and ASEAN, they are examples of markets with relatively high dividend yields. So therefore, in the portfolio, we have included ETFs that track these two markets. And just now, I also briefly mentioned about ETFs with a dividend tilt. And so in this portfolio, we also have an ETF with a dividend tilt that invests in the China stock market. And this particular ETF is able to generate a forward yield of 8.2%. Whereas if you have invested in a generic China or Hong Kong ETF, it is likely that you will get a much lower yield of about 3 to 4%. So ETFs with dividend tilt, they can provide investors with much higher yields due to their focus on high-yielding companies. And lastly, the fourth ETF here also provides us with exposure to dividend stocks. And in this case here, we have a REIT ETF. And nowadays, REITs, they are yielding at about 6%. For some investors, you may find that it's very attractive. But if you think that it's not good enough, then I'll leave it up to you to decide on how much REIT exposure you want in your portfolio. And moving on to the fixed income portion of the portfolio, we have chosen a total of 5 ETFs. And the allocations here, they are based on our FSM managed portfolios, also known as MAPs. So on the safer investment grade side, we have ETFs that provide us with exposure to Singapore bonds as well as Asian bonds. Because I think if you're a Singaporean investor, you do want to include a Singapore bond ETF into your portfolio, as you won't have to worry about currency risk. Now, on the more riskier side, we also have ETFs that provide us with exposure to high-yield bonds as well as emerging market bonds. So these kind of bonds, they tend to carry a lower credit rating, which means that they are relatively of higher risk. And that's why you can also see that these ETFs here, they are able to provide you with relatively higher yields in order to compensate investors for the additional risk. But do also note that the US high-yield bond ETF and the emerging market bond ETF here, they are both listed in the US, so they are subjected to dividend withholding tax. But don't worry, the yields which are listed on the screen here, they are post-tax. But regardless, if you are not comfortable with holding US-listed ETFs, feel free to leave them out of your portfolios. But overall, if you use this set of ETFs and follow the allocations stated on the screen, it is estimated that you will be able to generate a yield of 6% on your portfolio. And that is not all. I also want to take this chance to share with you more about some of the ETFs that we have included in our model portfolios. Now, the first ETF that I've highlighted here is called the China AMC Asia USD Investment Grade Bond ETF. So as the name suggests, it provides you with exposure to Asian investment grade bonds. And based on the chart shown on the screen, you can see that the key source of Asian investment grade debt is China. But what is also more important to note is that the majority of the Chinese investment grade issuers, they are your state-owned enterprises, also known as SOEs, whose economic values are being driven by state policy. So in other words, Chinese SOEs, they are very important as they form the backbone of China's economy. And this particular bond market also offers diversification as issuers span across different sectors, including financials, sovereigns, industrial, technology, as well as real estate. So we'll be investing in bonds which are issued by companies such as the Industrial and Commercial Bank of China, also known as ICBC, as well as a Sinopec Group and China National Offshore Oil Corporation. So both of these, they are state-owned oil and gas companies. And currently, yields in the bond market, they have reached a high since the GFC. However, we believe that credit fundamentals remain very sound, and Chinese issuers in particular, they are entering the global economic downturn from a position of rating stability. And furthermore, we think that investment-grade bonds, they tend to be less vulnerable to economic downturns due to their higher credit quality, as well as the general flight to safety. And as such, we do not expect the valuations of Asian investment-grade bonds to widen substantially compared to their high-yield counterparts in the event of a recession. And so with yields attractive as well as valuations undemanding, we believe that it will be great for investors to have an exposure to Asian investment-grade bonds through this particular ETF. And this ETF also pays out distributions every quarter. And next, the second ETF that I want to highlight over here is called the Spider Straits Times Index ETF. While this ETF should be familiar to many of you, I suppose, I also do want to emphasize that this is a must-have ETF for local investors looking to build an income portfolio. Now, the Singapore equity market, it offers resilience due to its large exposure to value stocks, which is relatively more defensive. And value stocks, they can typically be found in sectors such as financials and industrials. They tend to do well during periods of high inflation, leading to an outperformance against growth stocks. And as you can see, based on the charts on the screen here, the majority of the STI is being dominated by value in the form of the financial as well as the industrial sectors. And top holdings, they are your three big banks as well as relatively mature companies. And moving forward, we believe that Singapore banks, which form the largest constituents of the STI, are very well placed to benefit from the environment of higher for longer interest rates. And we also believe that the systemic risk from the collapse of SVB is relatively low. For SVB, a large part of their client base is startups, while for the Singapore banks, their customer base is diversified and is supported by very large corporates as well as a very solid retail customer deposits. And we believe that Singapore banks should also remain resilient even if we enter into a recession because they remain very well capitalized. So investors looking for value exposure as well as very solid dividends should consider this ETF for a diversified exposure. And this ETF also pays out distributions on a semi-annual basis. Now, the last ETF that I also want to highlight is called the Premier Dow Jones Emerging Titans 100 ETF. And this ETF stands out from its peers due to its focus on EM ASEAN, which also means that this ETF does not invest in Singapore. So as shown by the charts on the screen, the largest markets in this ETF, they are Indonesia, Thailand, and Malaysia. And on a sectorial level, there's significant exposure to your banks, consumer staples, as well as industrial stocks. So for us, we believe that ASEAN is a very resilient part of Asia, underpinned by a supportive commodities outlook. And over in the longer term, the region is also a key beneficiary of global supply chain reconfigurations amidst the geopolitical tensions between the US and China. And EM ASEAN's young and large population, which is increasingly higher educated, also suggests that this region is very well positioned to take advantage of tech trends that could help to boost economic growth. So investors who want to gain exposure to this high growth region should consider this particular ETF, because unlike typical ASEAN ETFs, the exclusion of Singapore can help Singaporean investors to gain a more balanced exposure across the different ASEAN markets. So essentially, this ETF can act as a complement as to the STI ETF to gain ASEAN exposure. And for this ETF, it also pays out distributions once every year. And so with that, I hope that you have gained some insights on how to create a passive stream of income that can withstand the test of time. So that's all for my sharing for today. Thank you so much for your time and attention.